Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am CEO and founder of Sound Financial Group, joined as always by Mr. Corey Shepard, who is president of Sound Financial Group. And we got a few things to explain today. Number one,
Like why we're wearing these crazy shirts.
yeah, why are we going lumber sexual, as they like to say? With they,
Who,
Corey,
who's they?
they.
Which they?
And then on top of it, we're going to be explaining this enormously complex tax bill, which requires no explaining. That's the topic of the episode. We're also going to be discussing why there was no intro music. And last but not least, why is it I have an axe in the studio today as we chop down all the trees required to print this 5,000 page bill? Or however
Now, is
long
that
it is.
actually the same company that makes the baby food and the Gerber Life Plan?
I'm pretty
I
sure.
always wondered that.
Yep. I think those
Seems
are the
like
same. The people that create those amazing knives for gutting a deer, yeah. Also the same people that create
and
that cute
right.
applesauce and the baby life insurance. I think not, but I would like to think that that's the case. So first up, just a little housekeeping for everybody. The reason we no longer have the music for the intro to this episode is because we can't stop this music from getting us copyright strikes when we post it. We don't know how to undo it. We've licensed it. We've spoken to the people we licensed it and paid for it through. We can't unwind it. So we're just not going to have it on our episode because it's stopping people from getting this great content. Now on to the lumberjacks. we thought we'd do something a little fun and different to talk about this new reconciliation bill. It's been in the news a lot. There's a lot of potential changes coming for people, especially of high income or if you have capital gains or if you care at all about controlling, say, the taxation of your retirement accounts in old age. This episode will be for you. Anything else, Corey? Did I
How
miss
about in
any of our
any
hot
age?
topics?
No, I don't think so. I mean, maybe that's kind of the point of this bill is there's a lot in it. There's more surprising different pages than the menu of the Cheesecake Factory. Like, what? Enchiladas and pasta primavera on the same menu?
Well,
It's kind of like that.
not only that, but I would appreciate it if on these bills they just added pictures. I mean, that would make it so much easier. Just fill up some space. I would understand thousands of pages in a bill if it included pictures. But I actually opened the bill and I read the bill. Now, I didn't read all of it. I read some subsections. And let me tell you, number one, if you've never had the opportunity to pull up a big bill like this, I would highly recommend just pull it up. Just read a section of it of something you're interested in. Use Control F on your keyboard. Find something you're interested in and see if you can make any sense of what they wrote. Like, you've got to be like an attorney that graduated at the top of your class. You can't even be a
Right.
regular attorney and digest some of the stuff they put in, because they're like, reference this section B. So I'm like, all right, copy that, put Control F, find that section. It's terrible. And with that, I think we can all agree that our political class makes things enormously complicated. We just can't help it. So that is a system we got. It's the best one I know of. That's why I still live here. So with that, Corey, you ready for this reconciliation bill?
I, I mean, it's here. Whether or not I'm ready, it's coming at us. That's why we're doing this episode.
Well, just for fun, what I thought I would do is give you guys a sense of what it looked like to research this. And so, Corey, I've got up on the screen this bill. So I want to give you guys a little insight into what researching this episode looked like. And this is the thing that first jumped out to me. I've been compiling stuff on this for over a month just to be able to give people a look as to what the taxation side is going to look like. But just in the last week, wanted to update any of our research before the episode records. And when I searched, 233,000 results for Congress reconciliation bill, specifically in the news. But as I scroll down here, New York Times last wrote about it 2 weeks ago. A month ago, NPR. 3 weeks ago for CNN. PolitiFact a month ago. Infrastructure bill vote on Congress negotiations 1 week ago. One of the things that's occurred is this was supposed to be brought to a vote by the 27th, a self-imposed deadline that Nancy Pelosi had made. And then that got delayed till September 30th. And the main infrastructure bill that was agreed on by the Senate has not been passed in Congress. And Congress hasn't passed that big reconciliation bill that's like 3.5 trillion. Some say 5.5 trillion when you count all of the counting. So there's a differing of opinion there, but we'll leave it at 3.5 trillion. I mean, with that many zeros, does it like
What's a couple?
what's a couple trillion more? I mean, really. But we're going to go first to this CNN article, and this is going to be posted in the description for all of you. This is not so much, they didn't do much in understanding the taxation and how it's going to affect most of you listening to the show. But what they did do a good job of is just walking through in the first 3 quarters of this article. You can see it's pretty long for those of you watching on YouTube. And it talks about all of the programs this is going to take care of. And it's expensive. It's a lot. And it's just important to read so you can see what's in there and be able to understand why they might have to be raising taxes so much. Now, the best summary of the bill that we could find, and it wasn't totally complete, we're going to go a couple of other places, was the Journal of Accountancy. So thank you, Alistair Nevius, JD, for putting this together. So we'll first talk about how it affects business. So it would replace the current flat 21% tax rate with a graduated rate starting at 18% on the first 400,000 of income, then 21% up to 5 million, and 26.5% on everything above 5 million. So for many of you out there, these will be the companies that you do business with, probably, that get impacted by this, companies you're customers of. It's pretty good, $5 million plus profits, a great little company. We have some of those companies as clients, but the vast majority of them are going to be larger companies that are impacted. Then there's going to be an interest deduction limitation, which will affect, again, larger corporations, affect how much interest they can deduct on their books. We also have, go ahead.
Oh, I was looking at the cap gains next, but I might be skipping a little.
No, we'll go down to that because a lot of this, as you can see, there's new foreign-related income measures, carried interest, and capital gains. So you've got some other things that affect large corporations. I encourage you guys to look at them, but those are going to be much better applied on the ground level with your business when you file your returns. But definitely be a reason to work on strategy with your CPA. Let's talk about tax rates. Go ahead, Corey. I'll let you take it from tax rates.
Well, so first thing I noticed is that cap gains is going to go up from 20 to 25% at the top bracket. And there's a little bit of a transition rule that seems helpful, but also just now it doesn't say here in this article, that's just on the top bracket. It doesn't say anything here about the step up in basis on death, but I think that's the other part of the cap gains piece that they're trying to add in, is that right now, if you left one of these accounts to your heirs that had capital gains, they get to inherit it at the current market value as the basis, meaning they don't have to pay any of that capital gains tax. And the rationale is that there's likely some estate tax on that money anyway, if on the higher account, so they're not going to double tax it. It's also positioned as something to help smaller businesses and smaller, families and kind of tax the rich. But you imagine a family business worth a few $1 million, like for the whole business, is still not a 1% family, and they're going to lose that. I just think of like farms, the like bedrock of like the American middle class kind of picture in the political narrative. Whether or not that's true, that is what shows up in the narrative a lot. And all of those small farmers get hurt a lot by this capital gains change, I think. So,
and it could be the guy that struggled to build 5 restaurants, the woman that has opened up 7 franchises in different cities, not a huge business, but enough to get a high enough valuation at sale that they could be paying a lot of extra taxes. And that 25%, the good news is that 25% target is down a lot from where they started, which was 39.5%, equal to income rates for people over a certain income threshold. And it appears that's no longer on the docket. It's more like this 25%. But if you're in the state of California, that plus your top income rate could put you just south of, or maybe just north of 40 because of your income tax rate. And then you'll see later that there's an additional 3.8% tax that still exists today for people when you have high income and you sell a capital gains asset. And that comes out of the Affordable Care legislation from many years ago. But what we don't see here is that you've got the 3.8% plus to California or other states. For those of you listening across the country, you could easily be over 40% on your cap gains as a result of this slight move.
Ooh, retirement plans is next. This is where the guillotine is really starting to drop. This is crazy. So anybody who's been listening to us for a while, or any of our clients listening, know about strategies like Backdoor Roth, Mega Backdoor Roth. Well, this is going to start to go away as an option for some people. Now, it's a fairly high line. So basically it's saying if you have more than 10 million in IRAs total, or is it just Roth? Yeah, in IRAs total, you can't put any more money into Roths. So it's not necessarily impacting a ton of people right now, but the second they start lowering that number means it's going to go even lower in the future. Like it's even easier and easier and easier. It's kind of a thing that we don't really want to give any ground on our planning strategies.
Well, and that really takes us to that next point that talks about Roth conversions, and basically an elimination of Roth conversions for anybody making over $400,000 a year. Now, in what I read on the debt score on this, Corey, and this is the thing that was like shocking to me, is they said, well, we think it's going to raise like $72 billion a year or something like that on the elimination of this. But if you look at how you fund a backdoor Roth, you pay taxes on your money first. You contribute it to an IRA, convert it to Roth. So the only tax avoidance is on the growth of that money, because they score these in 5 to 10 year increments. I have no idea how they're getting to 87 billion. I think it almost all has to do with some estimation they've made of these new required minimum distributions for large IRA accounts, that they're going to get to tax that. And unfortunately, they're going to put that on, a regular business owner, a regular household that is making good income, top 1% income, but we're just going to boil it down to their level as well.
Right. Now, here's where I think this could really impact a lot of people. Let's say as a household, you're not making 400,000, which is the max for this Roth conversion now under this bill, but you're making 300,000. You're noticing that taxes are going up in the future. So you want to convert 150, 200,000 of Roth. I think what this is saying is that would put you over an income limit. Like it would block you from making as many conversions as you want, because that adds your income to your taxable income. So I think it's actually going to limit a lot of choices and strategies for a lot of people.
Yep. Totally agree. Now, there's some other things. S corps would be eligible to reorganize as partnerships without triggering tax. Now, in some conversation I had with the CPA firm that we retain, both for client consulting and for our own taxation, and in a conversation with them last night, one of the things that's talked about in the bill, and I want to scroll back up to it so that those of you that are looking on YouTube can see this, is the capital gains tax, and that its increase would be any transactions after September 13th, 2021. Now, this would be the only, I believe, the second retroactive income tax assessed. The last one was under the Clinton administration.
Wow.
Like in our lifetime. And so one of the things that he said is they put that kind of thing in all the time, and it's meant to not cause a bunch of upset in the markets, people selling to lock in lower gains, all of that. because they shrugged their shoulders. So, well, it's already going to be backdated, so I can't do anything now. But two things. One, if you guys had a coach or an advisor that was saying capital gains rates are the lowest they've been in a long time, we should harvest those gains right now, it's worth listening to them when they bring that up. Second is that what will likely happen upon implementation of the bill is that date will be moved forward, and they avoided the thing they were after, which is they didn't want to have upheaval in the stock market or in the real estate market, people selling their holdings simply because of an impending tax bill, because the impending tax bill says you're going to get swept up already. But the general practice is they remove that backdating so that nobody has to take the hit politically for the fact that they passed a tax on people that people didn't know was going to be a tax on them. So now we're going to hit a couple of other fun topics in this. One that I think is, should we go straight to the CNBC article? Corey, House Democrats propose new retirement plan rules.
Sure. Yeah.
So the big one on this, which we'll go deeper into, I'm looking for the segment of this article that talks about it. We talked about contribution limits. That's the other thing they're going to limit. There's a strategy where you can over contribute to a 401k, convert that to Roth. That's also coming off the table. We talked about the mega IRAs, which, by the way, I think is a terrible political ploy. There are very, very few people that have done these major conversions. In urban legend that we've talked about is like Mark Zuckerberg's $4 billion Roth.
Or Peter Thiel has talked about in here, the $5 billion Roth.
Yep.
The only reason is that in 99, he happened to put whatever shares of something in there, and they've just gone crazy through the roof.
Exactly right. And Mitt Romney, I think, did it with Bain Capital stock.
Swan event.
Yeah, exactly. Right. And so those are super rare. People try to do them all the time. Nobody talks about that when a client pays $100,000 to convert an IRA to a Roth on a small oil company that they think is going to go through the roof, and then it fails, and their Roth is worth $10,000 now because the stock plummeted, you don't get credit back. You just pay the taxes on the conversion. You didn't get a windfall. And I think that happens a lot more often than these billion-dollar Roth IRAs happen. So we already covered the backdoor Roth. This one is super interesting and probably does a better job of avoiding the billion-dollar Roth IRAs than to limit people doing a regular backdoor Roth. And that's this, that accredited investors if you're an accredited investor, you couldn't invest in anything that requires you being an accredited investor inside your IRA.
Yeah. So Peter Thiel would not have been able to put whatever that startup,
that angel stock or whatever. Yeah. And nor could you. So if you're like, well, I want to invest in timber futures. Nope. If I want to trade options, well, no, you got to take a class for that. And that's how they qualify it, is if you had to take a class, require a certain amount of education or financial hurdles like your income and net worth, you're not going to be able to do those in an IRA anymore.
So it effectively removes the self-directed IRA as we know it.
As we know it today. Now, unknown whether or not that'll affect the ability for somebody to put money in an IRA and go write a check for a piece of real estate. Of course, you can't leverage money inside of an IRA. You can't get a mortgage. But that would do it. That right there would stop a lot of the ways people have been able to use their IRAs. Now, speaking of something hidden in the bill, yes, we'll go on to Forbes. Hidden in the reconciliation bill, a retirement plan mandate that will take most people by surprise. And so basically, under the proposal, starting in 2023, employers with 5 or more employees would have to offer a retirement plan and automatically enroll employees, diverting 6% of their pay to a retirement account. An automatic escalation clause would increase the automatic contribution to 10% by year 5. The default plan would be a Roth IRA invested in a target date fund, a mix of investments based upon your expected retirement year.
So there's parts of this. Yeah. Well, there's parts of this that well, if I was going to design something like that, these are some great ways to design it. A Roth, target date fund, uh, some automatically increasing contributions, because employees can opt out. So great. It gets some people to put some money away in a place that's actually fairly flexible, because a Roth IRA, they can get it back out again if they need to.
Mm-hmm.
But mandating an employer with only 5 employees, like, this person might not actually be making any money.
And you got to
Like
take
they
6% of their pay and put it in. And I think what you're basically doing
right.
for a lot of entry level workers is just creating a lot of extra paperwork for the employer. You are, I'm going to bet, you end up submitting them to ERISA regulation, which is pretty heavy,
Mhm.
in a company where they still don't have anybody running HR. It's still the business owner kind of doing their best to take care of
Right.
people, and they make mistakes and they make paperwork mistakes. That's why they don't have a 401k now. Is they're just trying to keep the lights on, keep the business running. A guy with 5 employees is probably not sitting back making $3 million a year and not taking care of his employees. If he is, those employees are going to move on.
Right. And there's some other kind of funny things, like the plan must be not just any IRA, but those in which there's an option to convert the account balance into an annuity at retirement. Now, as far as I know, that's actually every single IRA in the world right now, because you can take an IRA balance and roll it into any annuity that any company's offering right now anyway. So what that exactly looks like, and it's going to be funky. It's going to be the printer scanner copier of the retirement world,
Mm-hmm.
where all of it built in automatically. None of them do as good individually as the one thing would have done by itself.
Yes, exactly. I could not agree more. It could, in Oregon, for example, this is an example of something that's already in existence. Employers are defaulted in a participation to a state managed IRA. That might be the scariest words I've ever spoken on the podcast. State
Managed.
managed IRA.
Yeah.
Uh,
And
and
some of our clients in California were already getting out ahead of, they're going to have to put it in place next year already. So it's happening in some other states.
Exactly right. And now I don't know if it's like good or not. I tend to lean toward anything you mandate for a business without a direct causal outcome, like less, petroleum products being dumped directly in the East River.
Right.
Like if we can't immediately go, this is causing this, and this is the outcome we're after. If it's like, well, it's sort of good for society, like when it gets a little
Right.
fuzzy like that, is when I'm like, let's stay away from the mandates. But now there's
Here's what I would
also
love more. Like, think about this. If if the government just created the United States 401k plan,
hmm
and anybody who was an employee of a business with 5 or more people could enroll it if they wanted to. Like, it's something that doesn't put the weight of all of this paperwork on. Like, if we could just have an IRA be 19.5 as a contribution limit if you worked for someone, like
I
for a company, right? Something like
that I
that,
agree with. Just make IRA and
right?
401k contribution limits the same. But what is funny is when you talk about the government 401k, that
Yeah,
people should just be able to easily open an IRA that they can contribute to. That exists now.
right.
I just want to scream. It's like, yeah, that's a good idea, but somebody can go on to Betterment or Vanguard or wherever and open up an account, put $100 in, and you're off to the races. You have apps like
Right,
Acorn, Stash. Like there's all kinds of places people can set aside money if they are the kind that set aside money.
right.
We have an upcoming podcast interview with a client of ours. Don't worry, regulators, we won't allow them to say anything positive about us while they're on the podcast.
In fact, they'll
Uh,
just start out with a whole list of insults.
yeah,
We've got just to push it in the other direction.
yeah, probably starting with this shirt I'm wearing today. But this person has never made much more than, I don't think, ever cleared 6 figures, and yet has a really substantial net worth and has a solid shot of just being able to quit in their early 50s here. They just don't need to work anymore. So that is possible. But the trouble is that the more, I think the more we force the hand holding and people having to get their account set up and they have to contribute and all of that, I think it runs the risk of just ticking a lot of people off. And I think that's part of the reason why this bill has lost a ton of its momentum. Before we started recording, Corey and I were talking about the old pork trading. There's like this senator would get just a little bit of this for his state, and this senator would get a little bit of that one. I think
Our bridge to nowhere for my state, like all those kind of things, right?
Cornhusker kickback is my favorite naming of one.
Yeah, yeah.
And yet, it's like that used to be small. Like, oh, we're gonna put $20 million in for the farmers in Nebraska to get this person's vote. Or we're gonna put in $30 million to social services in California to get this other person's vote. All of that now has become big, sweeping, nationwide impacts that people are advocating with more fervor for than they were advocating for their old kickbacks. They get just as much political recognition for pressing these bills, but none of the blowback of nationally anyway. Like, just think about this business model, Corey. This is totally not where we're planning on going, but but consider that if you're a politician nationally, and where you go is we're going to make these national sweeping changes. It doesn't matter which side you're on. You then can not only not make your state mad or a neighboring state mad because you got a bunch of money for your state on a national level, and expose yourself potentially later at re-election as a fraud because you supported something that helped your state that you had previously opposed because one of these kickbacks to your state was built into the legislation. That can be embarrassing. But when you're raising your fist in the sky and you're advocating for something on a national level, you get two bonuses. One is the people that voted for you, as long as you're an adept politician, you're supporting something that your voters like. And you invigorate a national populace who can now contribute to your campaign. You see, when you did a bunch of local stuff, you're only going to get campaign funds from your local people. So the more that they overdo things on a national level, and I'll give one example of where things get overdone that will be the most easy thing for people to get, and I promise will not offend anybody's political sensibilities. Yeah, and
I can only hope.
Yeah,
we'll see.
Moment of silence for Corey before I say this. So look at airlines, okay? Now, you guys may remember some years ago, there were many, many instances of people being trapped on planes without food and water and toilets overflowing, all that. And they all, there weren't a ton of them, but the ones that appeared on national news so prevalently that you think it's happening all the time. Now, what a reasonable person would ask is, why would airlines do that? Why would they risk making this huge amount of their customers? We're talking 200-300 people at a time, putting them in a metal cylinder out in the elements for hours at a time.
Tweeting like crazy. Yeah.
Totally. Yep. Now, why would they do that? It doesn't make sense. So a political solution to that was passing the Passenger Bill of Rights, a sweeping set of regulations for the airline industry that was intended to prevent that. But again, a reasonable person would have to ask, why would a private corporation do this? It's because the FAA's fines for sitting at that gate, especially for large planes, could be $250,000 for not pushing back on time. So what they were doing to navigate that FAA fine is they would push back early, and in their analysis across all of the customers, it's like, yeah, we're going to probably end up sticking some amount of people in an uncomfortable situation for an extended period of time. But as a whole, our people will get to where they need to go and we won't go bankrupt paying these fines. Simply put,
right. Whatever one or two customers they lose being mad is a lot less than $250,000 each time.
Yeah. So if they avoided 40 fines for every time they pushed back and rolled the dice that they would get off the tarmac in time, well, then they came out ahead. But rather than the government going back to repeal or change those fines, there's no benefit in removing something your name has nothing to go on. There's nothing for you to sign in a big bill or something like that because you remove something. Where you get your street cred is adding it. And that's a problem for many in the political class because they need to get reelected. They need to show that they had important legislation. And as you could see, like pulling back legislation, even when it's happened, like tons of regulations have been pulled back in the last 5 years. I bet you can't name a single politician responsible for it. Because or a regulation that was pulled back that you could tie to a senator, but all kinds of senators' names are on that, bill that was the passenger bill of rights. Okay,
Right.
that's it for my little bit
Cool.
of political soapbox. Let's hit on one last one, which is trust and estates, Corey, and then we'll bring this thing home. So this is the National Review, National Law Review, and so there's going to be some new things coming up. The bill proposes to reduce the basic exclusion amount for gift, estate, and GST tax. So
Yeah.
what that means is where currently it's about 11.5 million, they look at lowering it to 5 million, but is going to roll back further anyway because it was supposed to in 2026. It was only a 10-year bill.
They
Then,
were also limiting the individual annual gift exclusion, right? Like right
yeah,
now it's 15,000.
per doni, per
Like
donor
I
today.
can give, like Danielle and I could give 15,000 each to as many different people as we want. So the classic is, grandma and grandpa have 10 grandkids. They could each give, so they give 300,000 a year, 150,000 each.
Mm-hmm.
So now it's just going to be 15,000. I give 15,000 to someone.
Yeah,
Just one
one
15,000.
115,000. Big difference because, and that
Big
really
difference.
leads us to our next one because that's how a lot of people make gifts to trusts. They have
Right.
their approximately 15,000 and then they gift it, their spouse gifts it, and they do that year after year. And you can multiply that by the amount of beneficiaries to the trust. But a big tool in estate planning is something called intentionally defective grantor trusts. And what they're effectively going to do is make even these grantor trusts treated as their own taxable entity. So where we've been able to help clients with strategy and setting up a grantor trust, being able to put some money into it, and then as it grows, it gets income taxed at the grantor's tax rate. But for estate tax purposes, death tax, it's outside the estate, avoiding that, in this case, going to a $5 million estate exclusion. This is going to foul up a ton of estate plans that have to be redone or rewritten. And there's some sentiment that maybe the pre-legislation grantor trust will be okay, but any future transactions between the grantor and the intentionally defective grantor trust, for instance, let's say you said, I want the building back that's in the trust. I'm going to put in 3 million of cash and bring the building back out and leave the cash in. That transaction has to be taxed as if the grantor trust is a different entity. Whereas right now it's taxed like you just traded two things on your balance sheet, at least for income tax purposes.
Wow. Okay. I just thought of a double whammy. They're lowering the estate tax threshold, and there's a strategy where a trust will have a life insurance policy in it so that the beneficiaries can pay estate tax, keep the real estate or the farm or whatever, and have liquidity. And the way they do that, it's called a crummy trust, which sounds like it's bad, but it's actually good. It's
Crummy
sending
was
a
the name
letter
of a
out.
guy.
Yeah, was the name of a guy.
It was a crummy name.
Basically, they have to send a letter out to the beneficiary each year saying, hey, here's this money, and they have to not take it and let it go into the trust. It's this little song and dance with the government, and then that pays the premium for the life insurance. But what I'm hearing here is we're not going to be able to do that anymore because the grandparent that would gift the 15,000 each, it's going to mess up the whole way that they're paying for that.
Yeah,
And so,
what if that
yeah,
grandparent right now needs the $100,000 gift window because they acquired a life insurance policy that requires $100,000 of money each year? Well, now they don't even have the room to get the money into the trust.
and an even bigger tax liability at the same time.
And then
So
what will end up happening is that not only bigger tax liability, but now that $5 million exclusion is going to be chipped away at every year, as now those life insurance premiums to the trust have to be counted as gifts each year. So they'll have to file a 709 gift tax return year after year and slowly chip away at their $5 million. No valuation discounts for non-business assets. This is huge. So something you can do right now if you're trying to shift money to an estate, and some of these have lost some of their popular feel only because now it's been years. Like when I got in the industry, Corey, the income or the gift tax limit, the estate tax started at $625,000.
yeah, it's crazy.
Yeah, but and that's
That
back
was
when
20 years ago.
that's back when a horse was only $5. So you could have some pretty good wealth at 625,000. I don't even think we had cars. Nope, we had cars, but they didn't have the same amount of horsepower as we have today. I'm whipping out all the dad jokes. So yeah, I need to get a sound I can play when I do that. I do have a sound I can play when I make jokes. Thank you. You guys have been great. Appreciate it. So we're gonna be in a situation. So right now, let's say you had a piece of real estate, and it's like, well, I'm not going to sell it right now. This may or may not be the best market to sell it in. I've got a partner, which might make somebody else not want to buy it. You get what's called a valuation discount because it may not sell in the market for what you thought it was. So maybe you can value it at 65% of its value and then use the smaller value to do your estate shifting. But literally, unless it's a business asset, they're not going to allow the discounting. So assets such as cash, stocks, bonds, okay, those didn't get much discounts anyway because their market is so easily set every day. But real property, with exceptions for certain active real estate trades and businesses, would be valued as if the transferred such assets directly to the transferee at full value, which means no longer can you take $10 million real estate portfolio you built and use some estate planning measures to maybe discount that to be worth $7 million when you shift it to the next generation. So, and then also the other thing that's going to happen with trusts is that you end up with that extra 3% tax that still occurs for people over a certain level of income, but you start hitting that with trusts at $10,000. And these are all legislative proposals. Right? None of this is like guaranteed to happen this way. We've wanted to do our best to try to chop down the trees of confusion that have been created by this. And one of the things that's difficult that Corey alluded to earlier is there's so many things that are packed in. That's why it's thousands and thousands and thousands of pages. Yeah. It's actually kind of difficult to know what's in it. It took some searching for us to find out, and the media has been relatively silent on this for the last couple of weeks, which is like, my prayer is that means a lot of this dies. And what I mean by a lot of this dies is the reason all these taxes have to go up everything else is there aren't the votes. They have to pass it on some parliamentary procedure called reconciliation. Reconciliation means they have to either find revenue sources or cut budgets to equal the amount of spending they want to do because they can't get the 60 votes in the Senate that would allow for totally new spending. And so this reconciliation procedure is what's creating a ton of these taxes to be able to do the pay-fors for this, but those pay-fors are not free. You know, it's sometimes talk about that this bill would be zero cost. That is the equivalent of saying your mortgage is zero cost because your mortgage is $3,000 a month and you earn $3,000 a month. This is coming off the backs of somebody and will affect some people. Right. Now, we don't always know who or how in advance, but this is a lot of taxes, a lot of new revenue for the federal government. And as you guys get a chance to read through the CNN article, you'll see what they're for. The reason we're opposed to is you can get into all the agenda items, all of that, but I think they're just using bad math. Things like limiting backdoor Roth for regular people is not raising a ton of taxes because the guy who puts money in a Roth pays the exact same amount of income tax this year as the person that puts money into a savings account. And so it's kind of our hope that they will see the better of their ways in Congress and the Senate and not get this bill passed with this level of taxation. And there's some talk now of this bill being significantly scaled back, and maybe we'll see some of these taxes scaled back too. Corey?
Cool.
Anything else you want to leave everybody with?
I think we've said enough. There's a lot. So thanks for sticking with us and watch along with us to see what happens.
Well, just a favor, be sure to make a comment below. What's your least favorite proposal that's coming in on these taxes?
Yeah.
What is what is a way that you think it might affect you and your family? And then don't forget to like, subscribe, and share this episode, because without you, most people never have a chance to be exposed to this. And since we don't have any great takeout music because of this copyright infringement on YouTube, Corey's going to beatbox us out.
Yeah. And they edited it out. Oh, that's weird.
That was great beatboxing. I mean, I got to say, the way they did that jump cut, you could barely see you or I move on camera, and I think that was great. So with that, Corey,
I just got the email. It was because I did such a good reproduction of the beat from Just a Friend by Biz Markie that also just triggered the copyright infringement on these places. Dang it.
Thank goodness we cut that out. So all of you, thank you for being with us today. Don't forget to like, comment, share, subscribe. And you know what? Just email me some compliments. I could always use it. It was a rough day. If I have a bad beard day, especially if you guys would send me just random compliments, I would appreciate it. And as always, Corey and I hope that this has been a contribution to you being able to design and build a good life.